All right, then, so let's explore exactly how we got here and how this can be resolved. Mushai Kenyan is the chair of the Kenyan Association of Manufacturers. He joins me now from the Kenyan capital. Thank you very much for your time this evening, sir. So let's start there with concerns about dollar access among your members. What sort of obstacles are members of the association facing? Is there a hard limit on how much dollars can be bought in one go? Is there a limit above which you can't buy the US dollar? Walk us through the problems.
So thanks, Rama. Thanks for having me on. I think the challenge most of us are experiencing is getting the volume of dollars that you want on the day that you want it. And it is changes on a day-to-day basis and on a bank-to-bank basis. So basically what we're observing is that individual banks have different volumes of dollars or appear to have different volumes of dollars on particular days. So you can't be sure exactly what is the volume of dollars that you're going to get on a particular day. And that is then leading manufacturers to try and build up their volume of dollars. If you're an importer, you're trying to build up the volume of dollars that you have available ahead of time, which again creates more problems on the whole dollar availability market.
Because you're basically trying to front load your dollar demand. If you know you're going to need 100 million at the end of the month, you have to essentially buy that up as fast as you can.
As fast as you can, as early as you can. And that is both tying up cash flows and I would suggest also the dollar market itself. Yeah.
So just to be clear, is it that banks themselves are the ones who are saying, look, we don't know what our outlook for dollar access is going to be. So I can only sell you a batch of $50,000, $100,000. Is that what's happening here? That the banks themselves are the ones who are saying we're rationing access because we don't know how much supply we will have today, tomorrow, a week from now?
I think the way we understand it is one, no bank owns dollars or sits on a huge volume of dollars at any particular time. They are basically market makers. So they are importers and other people who have dollars in their accounts, and they then offer them a price against which they will give it to a purchaser of the dollars. Now, what happens is that depending on how many customers you have in your bank who have dollars on a particular day or a particular time prepared to sell, that then limits your ability to transact. What would happen, we think, in an ordinary market is that if the bank itself did not have from within its customers sufficient dollars, it would go out and either talk to other banks, or maybe even the central bank might get involved in giving them a few dollars to be able to fill in their market space. So that doesn't seem to be happening at the moment.
And
because
why,
if you look at
why is that, though? What is it that's stopping the interbank market? Because this was a solution that you argued for a little earlier. You said, look, we need a properly functioning interbank market to essentially make sure that that liquidity is spread out to where it's actually needed. But the market is clearly not functioning as it should. Why?
Yeah. I think that's where we don't actually have the detailed fact on what might be happening. Because if you look at it again, if we look at our broad dollar reserves in the country, how much dollars we have in the country, we have sufficient dollars to go around, but somehow they don't seem to be getting to the bank or to the particular customers when they need them. Now, having said that, it's good to say that for manufacturers especially, their demand of dollars has risen in some cases quite significantly, just as we've seen commodity prices rising. So as commodities prices rise, we need more dollars than we say we needed last year. So if we compare the transactions we've had in the past, we now need higher volumes. Not only that, one of the other challenges is that as the commodity markets tighten, you find that if you're trading in commodities now, you have to buy either in advance or you have shorter terms to purchase. So your demand for dollar is rising. So it is a fact there is a bit of a higher demand on dollars. And it's just our ability of the market to adjust and be able to fit to that. And I think the ability to trade a little bit more would be helpful to make that happen, yeah.
Okay, so I'm just looking at the headline numbers here. The country has about $8.49 billion in reserves. The central bank was telling us the other day that remittances in the year to March were $3.9 billion. And March 2022 had the highest amount of inflows they've seen on record. I'm trying to reconcile these two elements of the picture, because on one hand, the central bank is saying, look, we've got a lot of USD coming in, but at the same time, manufacturers, bank individuals also telling us there's a problem here. We're struggling to get access to dollars. How do we square that circle?
Yeah, and that is a big question. In fact, when we raised the issue, is what we said, we don't have accurate visibility of what's happening within the market beyond what our customers are experiencing. So we are on the receiving end of this. It's a little bit like our fuel story we had recently. We go to the station, we don't find fuel. There's a story behind it, and we can try and explore it. And we think it can be explored, it can be discussed, and then resolved, because it's about the conversations around that and resolving it that would help us move forward. Now, having said that, I think globally, a lot of currencies have depreciated. We know all the global constraints that we are facing. Kenya is not going to be an exception to that. So we just need to work out how do we do this in the smoothest way possible, in the easiest way possible, and then avoid compounding the issues for the marketplace, because we are then now compounding issues in terms of supply, in terms of cost, even to consumers and the general market.
Right. One other angle to that, supplier debt from government, supplier debt from government grew by about 40% year on year between 2020 and 2021. Now about 467 billion shillings, that's about $4 billion, is due by the government to suppliers. And it struggled to also settle the dues, as you alluded earlier, to fuel marketing companies. But at the same time, we're spending enormous amounts of money, roughly $8 billion scheduled for the next fiscal year, to settle foreign debt. So might this rationing we're seeing in effect here be a result of the central bank saying, look, we've got to try and preserve dollar access in order to be able to meet and service our dollar-denominated debt service?
I can't really say that that's central bank's view or government view, because I'm not in the picture on that. But I can say, like they said, the dollar flows still continue. The dollar flows are going to continue. Kenya is not stopping. We're still going to be trading our tea, our big exports in horticulture, our diaspora remittances. And we are hoping as COVID comes down that, we'll get tourists back in, and we'll still get our source of dollars coming in. On the other hand, we are still going to get pressure as the rising cost of commodities comes in. So there will be still some pressure on the dollar. But it doesn't mean we are not stopping necessarily. We do understand the government does have pressures on funding and the tax raising that they're trying to do to cover these gaps, as well as the IMF program that is in place. So we think we should be able to manage through those situations. But we need to allow the market to continue, because we are, at the end of the day, a free market economy. We've got no capital controls. So it is important for us to allow the forex markets to work as freely and as easily as possible, so as to avoid compounding the issues that may come up.
This is a topic this is a situation rather that from the banking sources I've spoken to, they tell me this is something that's been around for the better part of a year. In November 2020, we saw the regulator slap down Stanbic because of a note they put out talking about the problems in the FX market and the lack of visibility into it, what exactly is going on. You're speaking up about this publicly now. Do you expect any blowback from the regulator?
Well, we expect what we are hoping for when we are speaking about these issues, and we have been engaging with the regulators, we've been engaging with the banks since last year. What we expect is some sort of resolution to this issue, to ease the issues. So we are not raising the issues to create fights or wars or trouble for our economy. We all work in this economy and we want it to grow. What we are saying is, let's resolve these issues before they become other issues. I am always of the view that unsolved issues can start generating others that are unintentional. So for instance, we are now worried about whether will we get a black market in the dollar price, where there are other prices of the dollars off the, what do you call, the Reuters screen or the formal market.
Off the terminal.
So we're saying, let's avoid creating additional problems, even issues of supply, by dealing with the issues as they are. And so what we want is to deal with the issues. Let's resolve these issues. Let's sit together and say, what is the best way of getting around these issues? because we can solve them. I don't think we are the only country in this situation. We are not the first country in this situation either. And so there are known solutions towards this, and it's a lot about the engagement that is going to help us.
All right, one last question for you, sir. The 2022 finance bill, the one that essentially sets tax policies for the next fiscal year, that's going to be debated on a very tight schedule because we have an election coming through in August. What are the key tax changes in the finance bill that you want to see expunged?
Well, a big one is excise tax. I think we are kind of going to town on excise tax, putting it on everything, including packaging materials, raising it to very high levels. This was a budget that the Cabinet Secretary for the Treasury said was going to try and protect consumers during a very difficult times. But the addition of taxes on and taxes upon taxes is going to make things very difficult. We're also very concerned about taxes that are a disincentive to investment. We've been having a lot of pushback and discussion with them around things like investment deduction. We now have an interest restriction, and now they've compounded it by including a restriction on how much exchange loss that we can put onto our P&Ls. And exchange loss is not something that anybody has, anybody in the private sector. Exchange loss is within the broad economy and the global economy. So now being punished again for that through taxation, I think is pretty unfair. And finally, we have the big one around what the kind of deposit we're going to have to make if we want to make appeals to court around the tax appeals tribunal. So the request has been for 50% of the assessed amount must be paid into a separate account. We don't think that is reasonable. That is a very big restriction on access to justice. And in effect, if we look at the powers that are now being given to the Kenya Revenue Authority, we are creating quite a big monster that is going to become a difficulty for us. And we'll soon want a Bill of Rights against our tax agent, which is getting too powerful, we think.
Indeed.